Cal-Maine Foods just filed its fiscal 2026 annual report. Revenue down 31.7%. Diluted earnings per share down 73.4% from $24.95 to $6.63. Those are the numbers everyone will write about. Here is the one they will miss. In the fourth quarter, the largest egg company in America lost $35.9 million. Start with the full year. Revenue fell from $4.26 billion to $2.91 billion. Operating income fell 77.2% to $350.2 million. Net income was $316.7 million, and diluted earnings per share $6.63. Every one of those is still solidly positive. Cal-Maine did not lose money this year. It just stopped making a fortune. Now split that year into quarters, and the annual average stops being useful. Operating income ran $249.2 million in the first quarter, $123.9 million in the second, $35.9 million in the third, and in the fourth, an operating loss of $58.8 million. Revenue fell every single quarter. That is not a soft patch. That is a slope. That loss has a mechanical consequence. Cal-Maine does not promise a dividend. It pays a formula, 1/3 of each quarter's net income. A quarter with a loss pays zero. And under the policy, the company will not pay again for a later profitable quarter until it is profitable on a cumulative basis. The 10-K says it plainly. No cash dividend for the fourth quarter of fiscal 2026. Dividends payable went from $114.2 million to nothing. Cal-Maine reorganized into 3 reporting segments this year. Conventional shell eggs did the damage. Net sales fell 51.1%, and segment income fell 83.2% to $216.6 million. Specialty held its top line far better, down only 7.3%, but its segment income still fell 45.6%. And prepared foods, which barely existed a year ago, delivered $244.8 million of net sales after the Echo Lake Foods acquisition. Here's the mechanism, and the filing is unusually direct about it. The average conventional egg price per dozen fell 50.9%. Cal-Maine's cost per dozen fell only 23.8%. Volumes were, in the company's own words, relatively flat. So this was not a demand problem, and it was not a volume problem. Cal-Maine sold about as many eggs and got half as much for the conventional ones. One line looks like a scandal and is not. Selling, general, and administrative expense rose 4.7%, while revenue fell $1.35 billion. But look where it came from. Prepared Foods added $23.9 million of overhead because Cal-Maine bought that business. Corporate overhead actually fell 14.8% to $108.4 million. The company did not get sloppy. It got bigger in one place while the egg business shrank around it. Now zoom out, because 1 year of a commodity cycle tells you almost nothing. 5 years of Cal-Maine revenue runs like this: $1.78 billion, $3.15 billion, $2.33 billion, $4.26 billion, and this year, $2.91 billion. That is not a trend line. That is a sawtooth. And every peak so far has been followed by exactly this, which produces the single most useful number in this filing, and it is one nobody computes. Cal-Maine's fiscal 2026 revenue of $2.91 billion came in 0.9% above its own 5-year average of $2.88 billion. A 31.7% decline landed the company almost exactly in the middle of its own distribution. This is what mean reversion looks like when the only year you remember is the peak. Meanwhile, the balance sheet did not participate in any of this. Cal-Maine ended the year with $924.1 million of cash and securities, and nothing drawn on its revolver. Operating cash flow was $479.8 million. And during the decline, the company still spent $427.8 million on acquisitions and returned $362.7 million to shareholders. That is more than it earned all year. There is also a legal file, and it moved both ways after the year ended. On June 25, 2026, Cal-Maine settled the Department of Justice antitrust investigation, along with 17 state attorneys general. No fines, no penalties, no admission. The terms were compliance measures: 30 million eggs donated to food banks and $1.5 million to the settling states. But Washington state did not join, and roughly a dozen private antitrust suits are now consolidated in Wisconsin, with no discovery taken yet. So what is it worth as a normal business? Cal-Maine traded around $88 a share on July 26th. Capitalize a mid-cycle EBITDA estimate of $480 million at 7 times, add the net cash, and you land near $91 a share. A bear case near 62, a bull case near 128. So at $88, the market is pricing neither the trough nor another boom. It is pricing a normal year. These are implied values under stated assumptions, not price targets and not investment advice. The bottom line: Cal-Maine is not a broken business. It is a commodity producer that just finished a round trip. Whether the fourth quarter was the bottom or the beginning, the dividend formula will answer mechanically. So watch the first quarter of fiscal 2027. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai. Link in the description.